Is it difficult to calculate how much home you can afford? How do the professionals do it? The basic tool that lenders pre-qualify you for a loan is called DTIR, or simply debt to income ratio, to determine the most you can pay monthly for a house after your other monthly debts. For most part, underwriting for conventional loan needs a qualifying ratio of 36 to 45%. FHA loans are less strict, requiring 31 to 43%. So what that means is your mortgage payment for conventional loan should not be more than 36% of your pre-tax income and 45% of your total debt. And for FHA loan, your mortgage payment should not be more than 31% of your pre-tax income and 43% of your total debt. Hey, I'm Mike Kellian with Home Pros Real Estate, and if this is your first time on my channel, don't forget to subscribe, tag me to a friend or two, and just hit that like button below. Here is the thing: when it comes to pre-qualifying for a house, the lender are using your gross income, or in other words, your income before taxes, before insurance, 401k benefits. So what they do is they take your gross monthly income, multiply by 0.36, which equals some X amount of money. This X amount of money minus the monthly payment debt, which is, say, Y, is the amount that is left, and what is left will determine how much you will be pre-qualified for a home loan and what will be your monthly mortgage payment. Why is actually the monthly payment to qualify for? That is actually the formula the lender used to qualify you. Just to clarify, the mortgage consists of principal and interest. Every month when you pay your mortgage, some of the money goes to principal repayment of your loan, and the other part of it is the interest paid on the loan that the bank or mortgage company is collecting from you. And when it comes to your debt, they don't consider your entire balance, but just only the minimum monthly payment on it. So here is an example. If you're making gross monthly income of $8,000, you multiply that by 0.36, which equals $2,880, and you subtract $600 from that $2,880, which is your debt, and you're left with $2,200. Your monthly payment to qualify to buy a home is for $2,200. But think about it. You're not bringing home actually $8,000 a month. You're bringing home maybe about $6,500 to $7,000, assuming you have state, federal taxes, insurance benefits, retirement benefits. So after this deduction, you might be bringing home about $6,500 to $7,000 net income, depending on the deduction you have on your paycheck. So now you have $7,000 times 0.36 equals $2,520. $2,520 minus $600, which is your debt, equals to $1,920. So sit back and acknowledge that the lender qualification is based on your gross income. My advice to all my clients is please stay in the line of 28 to 30% of your net income, because that extra 7 to 8 you can save for an emergency. Something unexpected happens, like medical bills or whatever life throws on you, you have some money saved for it. And when they tell you you qualify for this monthly house payment, you think, okay, things are going to be okay, things are going to be great. And you go get yourself a house, and next thing you know, that monthly payment is a little tighter than you thought. And next thing you know, an emergency happens in the family, and the monthly payment for the house is not giving you very good time. What could you be done differently? Here is the thing you have to know. What you qualify for does not equal what you could afford. There is a golden number that if you pass this threshold, you're considered house poor or house broke. So don't let emotion take over you, but think about the future version of yourself when you can have a quality of life and house payment that does not get in the way. So what is the golden number? What is the threshold you don't want to pass? There are some school of thoughts about it. Number one, super conservative is 25% of your net income. Number two, the more tolerant, if you will, is 28 to 30% of your gross income. Whatever number is, you are the one to decide, but it is something you have to be aware of and you really need to understand. Example of what you can qualify. Let's say that, for example, your gross income is 8,000 times 0.36 is $2,880. 2,880 minus your $600 of debt, which is equal to 2,280. So 2,280 is what you can qualify for. Let's play with the number to figure out what you can afford. 8,000 times 0.30 is equal to 2,400. 2,400 minus 600, which is your debt, it's equal to 800. 800 is what you can afford. Unfortunately, for a lot of people, this number means they are not buying a house. This means you are not probably buying in the area you love to buy. This is like maybe you're not going to buy in the best area. You're not going to buy in the area that you were thinking about. This is probably going in a route of finding something very cheap or very small. This is when you need to decide maybe buying two-family home so you can rent one floor to help you pay the mortgage. You are not going to like me saying that, but you are making a much more informed decision, not for your current self, but you're making a better decision for yourself in the future, who might be in emergency situation or might be simply decided to focus on paying off debts or start saving more money. So do your own research of figuring out what that golden number is for you, not what your lender or your real estate agent tells you. Work with the real estate professional who is there for you to protect you from yourself and maintain a high level of security and safety during the process. At the end of the day, you're going to pay your mortgage, not them. It is best to consult with a trusted, experienced real estate professional. Please feel free to connect with us. We can help you determine your best options for you and make informative decisions in today's market. Hey, I'm Mike Arkelian. Don't forget to subscribe and smash the like button below. Until next time, be healthy and happy.